Hello, once again, everybody. Kevin Shortell here with part 5 of this ongoing series about how the coronavirus is affecting the real estate note, and the lending business. This video is going to focus specifically on forbearance and liquidity issues. Forbearance is something we're going to hear a lot about. We've started hearing a lot about it already. There's going to be a lot of misconceptions about what that is, how that works. I want to clarify that. And also, it is creating liquidity issues that, depending upon how long this goes on, where the economy is basically shut down, could become a very, very big problem for everybody. So let's start and make sure everybody understands what a forbearance is. These are two-way street type of agreements here, a little give and take on both sides from the lender and the borrower. So what happens is this: the lender agrees not to exercise their legal right to foreclose on a delinquent mortgage, right? If somebody goes delinquent on a loan, even a loan that you own, you have certain rights. And one of those rights is to foreclose on the property after it reaches a certain number of missed payments. In fact, we can even accelerate that loan and say we want the entire amount of the loan, otherwise we're going to foreclose. So as a lender, our part of the forbearance agreement is us agreeing to say, look, we will not foreclose upon you because of these delinquent payments. So let's say you're 3 months behind. We're not going to foreclose on you because of that. However, you've got to give us something back, which is this: the borrower agrees to a mortgage plan that will require the borrower to eventually become current again. So it's a temporary fix here. This is not something free. We're not just forgiving these payments. It is a deferral, if you will. We're saying we won't do what we have the legal right to do if you agree on some kind of a plan. Now, that plan could be, we'll allow you to miss a couple more payments, and then you have to start making payments again. We'll take the payments that you missed and put them at the end of the loan. But it doesn't have to be that way. We could say, look, you're affected by this virus, your income's been cut in half, so why don't we cut your payment in half for the next 3 months, see how it goes from there, and then we'll just take the rest of the money and put it in the back of the loan. Or we could even say, we'll take the money that you still owe us, we will go ahead and add that in over 5 years. So your monthly payment will go up a little bit after that once the economy gets going again. Now, in the private lending business, of course, you could just completely forgive that as well. But most people are going to go with tack it to the back of the loan. So it's a give and take, right? We're agreeing to do one thing, the borrower's agreeing to do another thing. If the borrower doesn't live up to that mortgage plan, then eventually you may have no choice but to get a deed in lieu or pursue foreclosure. Now, we're dealing with this in the private lending business, but of course, all the news you're hearing right now about forbearance has everything to do with government-owned loans. So when banks originate loans, Bank of America, Wells Fargo, whatever, when they originate loans, they turn around immediately and sell the principal and interest to government entities: Fannie Mae, Freddie Mac, and Ginnie Mae. Now, there's some difference between all of those, but we won't get into that. So the banks really become servicing companies. That's really all the banks do. They collect the monthly payment, which normally is principal, interest, taxes, and insurance. It might even have mortgage insurance on top of that as a fifth component. They get to retain that. They escrow that money. They pass through the principal and interest portion to Fannie Mae and Freddie Mac because that's what they have purchased. That's what those entities have purchased. So the new federal law says that people have the right, people who haven't been affected, right? People who have been affected by this virus, employment-wise, and income-wise, they can apply, because their loan is FHA backed, to getting a forbearance agreement in place. That gives them 90 days, which, by the way, can be extended pretty greatly. We'll talk about that in a minute. But initially, a 90-day forbearance plan. And by the way, that same law is applying to certain tenants who are in properties where the property owner's loan is also backed by FHA, Fannie Mae, Freddie Mac, etc. So there's two different agreements here. So the public's going to be a little bit confused. I think the general public's going to think, well, if I owe rent or I own a loan, I don't have to make payments. That is not what these plans are all about. In fact, as a private note holder, you don't have to abide by any of this. Okay, this only applies to loans that are owned and backed by the federal government. So Here's what Fannie Mae has to say for their homeowners assistance program, right? So here's the act under the CARES Act and everything else. And a big part of this is let's enable people. Hopefully this is temporary, but people aren't working. 22 million people at the time of writing this are unemployed. They're not getting income. Some of them may not be able to go back to work because their businesses haven't received stimulus money and the businesses can't open. So this could go on for some period of time here. So here's what they have to say in their report from March 18th. Homeowners impacted by this national emergency are eligible for a forbearance plan to reduce or suspend their mortgage payments for up to 12 months. Now they'll have to apply about every 90 days to continue an extension on that, because what they're trying to do is set up a plan and say, look, we're not telling everybody no mortgage payments for 12 months and we'll just tack it on the end of your loan. That would have an enormous impact on the overall economy. So what they're trying to do is give the people who are really affected by this the ability to go that far in 90-day increments. But you're going to have to show that you're not working in every one of those particular cases here. The next thing is this. How many people have taken advantage of this program? And I don't mean that in a negative way. How many people have applied? It's really probably a better way to put it. How many people have applied to this program because they have been affected? Well, according to the Mortgage Bankers Association, which now tracks forbearances for the first time ever on a weekly basis, they have seen requests grow 1,270% between March 2nd and March 16th, and another 1,896% between the week after, March 16th through the 30th. Expect that trend to continue to increase, especially if we have a delay in reopening all of the businesses, essentially reopening the economy. And once again, there's going to be some businesses that are going to struggle to come back. Some may never be able to come back, which means we may have an extended period of time of unemployment on this. So expect these to go up. If you have private loans, I've already said this months ago, get ahead of this curve. If you're late, if somebody's late sending you a payment, let's get a letter out there. Let's reach out and let's also offer forbearance agreements, hopefully, which we can simply lower their payment for a period of time, and then they start working again, and then the payments go up. And any missed payments, you can either forgive, you can add them into the loan over a number of years, or just tack them to the end of the loan, and that will service your clients very, very well. And I think that's the smart thing to do. And people will appreciate the fact that you're reaching out here. So already, the requests already have exceeded 2 million people by April 10th. Okay, that's the latest number that I had there. So expect this to continue to grow and grow and grow. This affects liquidities with mortgage servicers as well. So I want to talk about mortgage service liquidity issues here, but please don't get confused. If you are in the private note business, which you probably are listening to me and watching my videos, we have servicing companies that collect our monthly payments. They hold escrow. They account for the money. We can also contact them for workout services. Those are in the private lending world. What I'm going to talk about here very specifically is in the bank world. Right? There's much more regulations in the banking world here for servicing companies. And as I mentioned in the beginning of this video, companies such as Bank of America, Wells Fargo really become mortgage servicing companies for the federally owned agencies like Fannie Mae, Freddie Mac, and Ginnie Mae. They originate a loan, they sell the principal and interest to Fannie Mae. And then they just maintain the servicing rights. Why? Because they're able to make money on the origination, and they're able to make monthly servicing on all of these millions of loans that are under their servicing care, if you will. So big distinction here. So mortgage servicing companies, again, in the banking mortgage servicing companies have a contractual obligation to continue to make the monthly payments to the mortgage-backed security holders, even if the homeowner becomes delinquent. So in the banking world, Bank of America, if they don't receive payments from the original borrowers, as the servicing company, part of their agreement with Fannie Mae and Freddie Mac, et cetera, is that they have to make that payment to the mortgage-backed security holder, Fannie Mae, Freddie Mac, Ginnie Mae, even if the payment doesn't come in. Now, eventually they'll get that money back, but to keep the system flowing, they pay for that. Okay, again, in the private note world, that does not apply. In the private note world, that does not apply. You're not going to have your servicing company, you own a private note, say, hey, you got to make the payment for me. That's not how it works. But in the banking world, it does. So services will get reimbursed by the government-backed entities, but that can take several months. So they're temporarily on the hook. Now, overall, that's not a big problem, right? The banks have cash reserves. In fact, they have reserve requirement issues, and those requirement issues have increased because of Dodd-Frank. So banks can carry that for several months. Now, how many months, we don't know. They're going to run into problems if this continues to go on because they will not have the capital reserves any longer to make those payments come in and wait for reimbursement. Okay, that sounds like a bailout once again. But non-banks are even in worse condition because non-banks are not regulated the same way. They don't have capital or reserve requirements. Okay, the banks do, but the non-banks don't have those same requirements. In fact, non-banks try to use as little as their own money as possible. What non-banks do when they do loans is they have warehouse lines of credits from the big banks, and they use their money and make spreads. So, if they're losing money because payments are not coming in and they're not servicing loans, how are they going to survive? And that becomes a big issue here. So expect one of the biggest battles coming up in the lending business is, should the federal government bail out non-bank servicing companies and non-banks? It's an interesting issue because they are not backed by the federal government, and they should be in the business of building up their own cash reserves and et cetera. So we'll have to see what happens there. But just to give you an idea, if the servicing companies are not paid, and this can include banks now, by the way. In fact, this is from a very lengthy report from AIE.org. And I just took one page of this, and this one specifically relates to Ginnie Mae. Ginnie Mae is the secondary note buyer that is wholly owned by the federal government. And they've been buying a lot of non-bank and bank-issued loans. So under their books, if you will, Ginnie Mae owns loans from 10 million borrowers. The servicing fee is about $45 per month. So that means $450 million in monthly gross servicing revenue is paid out to these servicing companies, which are the big banks and the non-bank lenders. Now, for 6 months, if the economy takes long 6 months to recover and people starting to make payments again, in other words, they've been granted a forbearance for 6 months, that means $2.7 billion in gross revenue over 6 months at a 70% forbearance take-up rate, meaning 70% of people apply for these and get a 6-month extension to not make payments. That's $1.9 billion gross servicing revenue shortfalls over 6 months. So it's a big deal for these servicing companies, and they may need a bailout as well. In fact, some of these companies are already dead in the water. They can't afford to sell their notes. They'd go out of business. If they sell their notes right now, they have to sell them for less money than they have in them. They'll sell themselves right into insolvency. They will be out of business. So they are literally hanging on, waiting to see if the government is going to bail them out. That's going to be the next big fight. So it could get a lot worse, everybody. So I'll be reporting as information comes in here. Hopefully, we get the economy started a lot sooner and we don't run into numbers that are as scary as these. But remember, if you own your own notes right now, you own your own business. It's a private business. You're not have any requirements such as the banks and the servicing companies with the non-banks have. You're completely separate. You're not under this agreement. But it does make sense for you to be proactive, protect your portfolio, negotiate the best deals that you can so you come out great on the other end. It's been Kevin Shortell, and I'll be talking to you again soon.